Hi there, we're taking a look at a past exam question, and this is a 16-mark question from a previous paper 2 for AQA A-level Business. And the question there is on the screen. Using the data, recommend whether Drake Hotels PLC should go ahead with the proposed investment. Justify your answer. 16 marks available, and this is a quite a straightforward question in terms of unpicking what the examiner is looking for. They're looking for you to respond as to whether or not the case study business Drake Hotels should go ahead or not with the proposed investment. So that's really straightforward in terms of where our analysis and evaluation needs to head. We obviously need to show some balance in our arguments, but then also have a supported judgment as to whether or not they should go ahead. And in particular, we need to focus on the precise wordings of the question. We need to use the data. This was a case study that provided us with lots of information, data about this proposed investment in a new hotel. We need to use it to support and on which to base our arguments and therefore our judgment. Well, one of the things you need to do is, as always in paper 2, is to use the information given. And here, as I say, we were given lots of information. We were given some quite positive data that might provide you some evidence to support an argument about going ahead with the new hotel. In particular, the investment appraisal results. So we were actually given the results of net present value and ARR, and the data suggested this was quite positive, a positive NPV of 25 million. And that's, of course, taking into account an initial cost of investment at time zero of 20 million. So a very positive NPV. We were also told that the ARR of the project is 12%. We didn't have to work it out. We were given that. We were told the business could borrow money at 8% to finance the investment in the new hotel. And also, we could have done a calculation. We were given sufficient information to work out return on capital employed, which I calculated as being 4%. I'll show you that calculation shortly. Some other positives you could have drawn on. You don't have to use all of this. The sensitivity analysis suggested that there were some potential upsides, in particular with an upside on income elasticity of demand for overseas visitors coming to the UK to stay in this hotel. In Oxford, of course, so a very attractive place for overseas visitors to stay for a night or two. And we were also told that the new CEO of the business had a good experience of operating luxury hotels. So lots of positives. On the other hand, to provide us some balance, we were told that Drake Hotels was already operating at quite a high level of gearing, which you could work out at 62.2%. And clearly, by financing the new hotel with extra debt, the gearing ratio would increase. One part of the sensitivity analysis told us that exchange rates might worsen to make overseas visits less attractive. So the pound, I think, was forecast to strengthen, making overseas visitors less attractive. And also we were told that Drake Hotels itself is a budget chain. It operates in the low-cost sector, and therefore potentially you might argue it had no experience of operating and marketing a luxury hotel. So there's our data that we want to try to use to underpin our response. So at this stage, you might want to pause the video if you've seen this question, got the case in front of you, and have a go thinking, well, what might your argument be for operating the hotel, for going ahead with the investment, and what might the argument be against, and where does your judgment, where does your conclusion lie? I'm going to take you through a suggested answer. It's not meant to be a perfect answer, but I think it meets the demands of the question. More importantly, it stays focused on the case study and not too much, so that you can move on from spending 15 minutes or so answering this question. Well, here's my argument in favour of going ahead. And as always, we're using for this particular response, we're using the pecan pie approach. So pecan, point explained, analysis with application, and then a little bit of evaluation at the end of this paragraph. I've got a paragraph to show you next, which doesn't use a slice of pie, point included evaluation, just to show you how you don't need to use it if you don't want to. So let's read through this. The investment appraisal data is positive and strongly suggests proceeding with the investment. Full stop. That is our PE, point explained. Don't get into any more application. Don't develop your analysis until you've stated the point that you want to then go on to develop. So, for example, the total of the forecast discounted cash flows of the Oxford Hotel is positive at 25 million. So demonstrating knowledge and understanding of what NPV is. It's the total of forecasted discounted cash flows. And this is significant as it fully allows for the initial investment cost of 20 million. Similarly, the ARR, or annual rate of return, or accounting rate of return, is 12%, and that's much higher than the existing return on capital employed of Drake, which I calculate as being 4%. We were told it's currently making a net profit of £18 million a year, and we were told it had capital employed of 450 million, so 4%. So the ARR is much higher than the existing return on investment. And this suggests that the luxury hotel will produce much higher returns than budget hotels, assuming, of course, that the forecasts are reliable. The investment appraisal data is further supported by the sensitivity analysis, particularly the 30% probability that GDP growth might be higher than forecast in overseas countries. And this is because it's a positive, because we're told that demand for luxury hotel rooms in the UK is income elastic. So a higher GDP should result in higher demand for taking a break and having a hotel stay in Oxford. And then to conclude this particular paragraph, overall, therefore, the investment data looks very promising, although it should be noted, much of it has been prepared by Mary Myers, she's the new CEO, who might have an interest in ensuring it is strong. Therefore, it needs to be checked. And I think that's a decent argument in favour of going ahead. And I've just highlighted in red here where I've drawn from the data, because the question asks us to use the data. So right from the start, picking and drawing out some of the information we've been used, and then manipulating the data. So I did a quick calculation for return on capital employed and used it. That was my 4%. And I also drew from the information on the sensitivity analysis. And right at the end there, at the end of paragraph, I've just sort of put a sort of slice of pie, point included evaluation, a little bit of evaluation at the end of that paragraph, just to evaluate as I go, saying it looks really promising. However, a note of caution that we need to be cautious about investment appraisal data, particularly because it's been prepared by the person who wants to open the new hotel. Well, I need some balance in my arguments before I go on to conclude, so I need to move on quickly to writing a paragraph that arguments why they should not proceed with the investment. And here's my effort, possibly a little bit too long, but see what you think. So there's my PE, my point explained. On the other hand, so signalling to the examiner I'm showing some balance here, there are some potential risks with the investment, particularly relating to whether Drake Hotels will be able to successfully market and operate a luxury hotel. That's it. That's my full stop. All I now need to do is to explain how and why that might be an argument for not proceeding. So let's read through. Drake Hotels is an operator of budget hotels, and consequently, the culture of the business and how it's managed is based around efficiency to enable it to ensure it has room prices that can compete against other budget hotels such as Travelodge and Days Inn. Although Mary Myers has experience of running luxury hotels, she will need to recruit a new team that has similar expertise. And the business may also incur costs in a different marketing strategy to position the new hotel differently to its budget hotels, perhaps by using a new brand name. Since the hotel would also be a new building, there must be an increased risk that the forecast returns from the investment prove less positive than included in the NPV and ARR results. So putting a question mark over those investment appraisal data. And clearly there's a potential concern that the investment is going to be financed using debt. And Drake Hotels already has a high gearing ratio, which might rise further if a new loan is taken out. Now, all I've done there is I've just outlined the argument, one or two parts to that argument as to why you shouldn't proceed. I've not included any evaluation at the end, but I've tried to make sure I've included the data and tried to make sure I've used the context provided. So more application interweaved into my my analysis. Well, I think that's okay. That's a decent argument. I've now got some balance. What I now need to give the examiner is an answer that I need to say, justify. I need an answer and to justify it. Should they go ahead or not? Well, there isn't a right or wrong answer to this. All the examiner is looking for you to do is to provide an answer and justify it. So I've gone with that they should. So here's my answer. Whilst there are concerns about running a luxury hotel and high gearing, overall, the investment appraisal data is very strong and supports going ahead with the proposed investment. Full stop. That's the answer. And all I now need to do is to justify it. Well, I've already provided some arguments for that with some balance to say they shouldn't. So I just need to develop my conclusion a little bit further. So indeed, if the forecasts prove accurate, so of course they may not, the new luxury hotel may significantly improve the overall returns on investment achieved by Drake Hotels. Now, I wanted to add a bit more application in, not another argument, but I think added application adds value to your conclusion. So, for example, a 12% average return on investment, that's from the ARR, on investing £20 million would add an extra 2.4 million of annual profit to Drake's existing profits of 18 million, showing the impact if those forecast returns are made. Of course, the investment appraisal data is uncertain as it's based on forecasts, so there's some sort of qualification. However, the sensitivity analysis is helpful relating to increased demand from overseas visitors, even if the exchange rate does make it a little bit more expensive for overseas visitors to visit the UK. Accordingly, the evidence suggests that Drake Hotels should proceed with what looks like an attractive. So that's it. That's a conclusion. I think that answers and meets the demands of the question. What do you think? If you're watching on YouTube, maybe post your thoughts into the comment section. But anyway, hopefully that's been useful for you.